Okay, so here's the review for the week starting on May 1st. As you can see, we have Monday right here. We have Friday right here. We ran out, took out buy side liquidity. Then we traded lower to take out sell side liquidity on the week. And then Friday, we traded higher to close in the middle of this range. Liquidity is basically where swing highs and swing lows are at. A swing high is when you have a candle that's lower to the left and lower to the right. So this would be a swing high. A swing low is the same thing, but opposite. So a candle lower to the left and lower to the right. So this is a swing low. Above these swing lows and swing highs is where orders are resting. So that is why it is called liquidity. All the concepts that I talk about are ICT concepts, also known as Inner Circle Trader. He has a YouTube channel, so if you ever want to learn directly from him, you are more than free to go learn from him. The goal of this channel is hopefully to help people digest his content a little bit better. He has a lot of content on his channel, and you don't need to know everything that he teaches to be profitable. So the goal of this channel is to help point out what I believe are the most important topics that he covers and hopefully teach it in a way that is more relatable to someone. But looking at this chart, it's hindsight, obviously. You see Monday takes out the buy side and Thursday takes out the sell side. But how do you use this information to enter trades before these moves happen? Well, in order to better understand that, I'm going to put some annotations on the chart and I will explain them. So I have these lines on the chart. These lines are representing a type of an imbalance. An imbalance is where price basically traded inefficiently. It either went up too fast or down too fast in a particular direction, and price always has to trade efficiently. So when we spot these levels of inefficiencies, these are levels that price will refer to in the future. So looking at this black line and this black line, you can see this candle's high doesn't touch the next candle, which is this one, low. So that gap in price is called a fair value gap. It's a gap of fair value. Price traded up too fastly or too quickly, and this gap is an inefficiency. Same thing here. This high doesn't touch this low, so that is another inefficiency in price. Now this one I have labeled as a BPR, which stands for balanced price range. So remember that this is an inefficiency because it traded up too fast. So when we have this low and this high, it starts off as the fair value gap. But once we trade through it, now we have traded with buy side going up too fast, and now we have traded with sell side. So now it is no longer inefficient, it is now balanced. So when price trades to that, it should be sensitive to it. Another way to think of balanced price ranges are basically failed fair value gaps or inverted fair value gaps. So once we trade through the fair value gap, it can come back to it, touch it, and go lower. Or sometimes, as we'll see in the future, it will trade through it to go to a lower inefficiency or order block or something of that nature, then go through it again, come back to it, and treat it like a fair value gap. We don't delete levels once they've been traded through. The algorithm that controls price will always remember these specific ranges. But now, just knowing where these inefficiencies are is not enough to trade intraday, day by day. With every imbalance, you want to break them up into quadrants. So you want to break it up into 25%, 50%, and 75%. When I drop into the lower time frame, you'll see that price is reacting very strongly to these very specific levels. And when you have a bias and a lower time frame key level within these daily key levels, those are areas where you want to enter the trades. So that is how you use the higher time frames with the lower time frames to enter a trade. I'm going to drop into them now to show you more in detail of what I'm talking about. But remember what these lines are representing when I drop into the lower time frame. So here we have the hourly chart. Monday takes out the buy side. Then Tuesday, we trade up into here, go lower into 50% of this fair value gap. Very good price delivery right there. Then we trade higher to come back up to the balanced price range. Remember, it's not a balanced price range until we trade through what was the fair value gap. Then it becomes a balanced price range and we trade up higher to it right here. React off of it. You see the reaction, very strong to go down to another very specific key level, which is the top end of this fair value gap. We trade into that. We go higher. We overshoot 75% or 25% of this fair value gap range just a little bit, but that's fine. And we go lower to take out the sell side. So when we hit this fair value gap here, we didn't take out the sell side. So what's price really doing when it's going up? It's just a retracement because we have unfinished business here. So once it goes up into here, we know that it's going to go down here, or it's more likely to go down here. And it does, and it fills in the fair value gap. And then price goes higher, comes down into what? Another very specific level, this dotted line, and then goes higher. Now, this is still not enough to enter a trade. Like, how do you enter the trade? You don't know which level is going to have the reaction or not. How do you determine whether this is going to have a reaction, this line, this line, this line, this line? How do you know? Well, I'm going to show you. So I'm dropping down into the 15-minute chart. This is the chart where I think you can do all types of trading. I think you can scalp from this chart. I think you can day trade, short-term trade, position trade. All types of trading can be done from this chart with the right context in mind. So in order to know when you want to enter a trade, you have to understand the timing effect. Time is the most important aspect of price. And time can be many different things. It can be time of day. It could be day of the week. It could be the week of the month of the year. All those time factors are very important. So this week we had two very important economic news events, which was FOMC on Wednesday at 2 p.m. and NFP on Friday at 8:30 a.m. So first with NFP, with FOMC, if we know that this is most likely the target. So this is Wednesday, this dotted line and this dotted line. Between that is Wednesday. After seeing Tuesday, there's a good chance that it's probably reaching for this sell side liquidity, right? So if we know that, FOMC is also at 2 o'clock, by the way, which is this swing high right here. So if we're trading here ahead of FOMC, and we know this is sell side liquidity, isn't it reasonable to think that it's probably going to run up a little bit higher, fake people into thinking it's going higher, and then go lower to target this blue line? Now, with that bias in mind, how high can it go up? Well, you have the daily BPR, the daily key level, but also you have this imbalance right here. Now, it is lined up with the hourly imbalance, which is why it's not at this low. But if you were just using the 15-minute chart and you entered here, it would have been perfectly fine, that you can see. But you essentially want to pair up a daily key level with a lower time key level after, this is very important, after you have determined your bias, after you know where price is most likely to go. When that all lines up, that is when you can enter a trade. That is where your trade setups are going to form. All high probability trade setups, and I mean all, every single one, will form around a daily key level matched up with a lower time frame key level. All, 100%, not 90, not 95, not 99, 100% of all your high probability setups will form at these very specific levels. Now, I also have these gray boxes on my chart, which ICT refers to as opening gaps. There's two types of opening gaps. The first one is the opening gap to start a week. So between Friday's closing price and Sunday's closing price, if there's a gap between that, Sunday's opening price, if there's a gap between that, that is a very influential range and you want to mark that on your chart. The same goes for new day opening gap. So there's an hour gap from when the day closes and when the new day opens. If there's a difference in price between those two levels, you want to note that as well. So with the new day opening gap, you can see right here, we closed here, we opened here. You want to mark out that range and draw it out in time. This is Wednesday to Thursday. So Thursday, we trade higher, we come to it, small little fluctuation, but remember what the bias is. This low, we haven't taken that out yet. We go down, and then we go back up to touch the bottom end of that gap, and then we go for the liquidity. That's another trade setup right there. One trade setup, two trade setups for the week. Just using daily key levels with lower time frame daily key levels with lower time frame key levels with opening gaps. That's all you need. Then, after we take out the sell side liquidity, we come back to the gap. We go one more time lower for the liquidity, and then we just consolidate, going, touching the gap, coming down, touching the gap, coming down, consolidate through that, and then we go higher, NFP 8:30 a.m. on Wednesday, which is this candle. We come down, touch the gap. There's also a small fair value gap here. Sorry that it's not zoomed in. So you have a fair value gap within the new day opening gap. We touch it, go higher. How high can we go? Well, these two gray boxes are new week opening gaps. So this is the new week opening gap for the week that we're reviewing now. This one is for the previous week. So, like I said with the fair value gaps on the daily chart, we don't delete levels once they've been traded to and through. The algorithm will always refer back to these price levels. So how high can it go? Well, it can go to the new week opening gap. The closing price of the week was $41.49 or $41.48.75, and the low end of the gap is $41.49. So you're one tick away from the new week opening gap. I would say that's pretty accurate. Also looking at the new week opening gap, look at the reaction there. Beautiful reaction. Boom. If you want to be a London trader. Now, I didn't explain this, but I have these shaded boxes for each day. These are the sessions that you want to trade. So the blue one is London session. The pink reddish one is New York. Also AM session. And then the green one is the PM session. These are the times that you want to trade because the most volume is going to happen here. If you look outside these shaded areas, so any part of the chart that's white, you can see the ranges tighten up during these times. Tight range here, tight range here, tight range here, tight range here, tight range here. This is the only time we had some type of range. If you want to miss that move, you can miss that move. You also see it's just one-sided. There's really no retracements. This range, I wouldn't consider this a tight range. I would consider this good movement. But like I said, sometimes you're going to miss a trade. But if you look at the shaded areas, this is the times that you want to trade. So just to recap what I talked about in this review, you basically want to identify your daily inefficiencies and liquidity. With the inefficiencies, you want to break them up into quadrants, 25%, 50%, and 75%. All of your trade setups are going to form around these daily key levels, and some more that I'll speak on later on in the future. But it's always going to be based off the daily chart. And then once you have these daily key levels, you want to drop down to your lower time frame and basically find a key level that matches up with one of those daily key levels. And once you have the bias with that right there, trading becomes much more simpler and it doesn't look like a big puzzle to you. But I hope this review was insightful, and we will be doing this every weekend. And I hope everyone has a blessed and safe week.